Hello everyone, it's Abweti at the KFX. Today we will be doing the first basics you have to know in Forex trading, being the introduction to Forex. And if you are new to the channel, please hit that subscribe button and click a notification bell so that you can be notified anytime I post a new video. So before a further ado, let's get into it. So guys, as you can see, we are already in the notes. This is how our notes looks like. So in this lesson, guys, you will learn the first basics in Forex, being the introduction to Forex trading, like I said on the intro. And these basics will help you guys to understand even more the language spoken in Forex trading, because all the tips in Forex trading you must understand in order to talk to other Forex traders. So let's get into the notes. So, introduction to Forex trading. What is Forex? Forex is simply the foreign exchange or the changing of currency to another currency. For example, guys, when you are exchanging whatever currency you guys are using in your countries to the US dollars, that's what we call foreign exchange, being Forex in short. Forex market has neither a physical location nor central exchange, but rather run electronically within network of banks. So that's the definition of Forex. And what is traded in Forex? In Forex trading, there is buying and selling of currencies based on their strengths at a certain period of time, and it is based on social and economic factors in specific countries. For example, guys, if USD is weak because of certain economical factors, then we will sell USD ZAR. Why? Because USD price will be going down, and in Forex, when the price is going down, we sell, and when it goes up, we buy. So when the USD is weak, meaning it is going to go down, right? And any USD XX currency will definitely sell. We'll get into that when we are still going further with this course. So what is currency pair? Like I told about currencies, currency pair in the previous definition. So what is this currency pair? What is the meaning of this currency pair? This is the combination of two different currencies with the value of one currency being quoted or expressed in terms of another currency. Like this is a pair of currencies in short. In this pair, we have a base currency being the first currency in any currency pair, and also a code currency being a second currency in any currency pair. For example, guys, if we have USD ZAR as a currency pair, this is where USD being the first currency in this pair as a base currency, and ZAR being the second currency in this pair is code currency. So USD is being expressed in terms of ZAR here in this currency pair. In this USD ZAR, USD is being expressed in terms of ZAR. So this means if USD ZAR price is 17.56 rands, that means 1 US dollar is equals to 17.56 rands. I think I'm clear. So in Forex, we have different currencies, but they are the most traded currencies in Forex, being United States dollar, euro, Japanese yen, pound sterling, Australian dollar, Canadian dollar, Swiss franc, and New Zealand dollar. So when those currencies are quoted against each other, they make what you call a currency pair, like I explained before. So what is bullish and bearish in forex trading? You will basically hear traders saying the market is bullish, the market is bearish. So what do they mean? Like I said, guys, we are going to know the first basics in forex so that you can understand the forex language. So bullish means um the price of a certain base currency is going up in expression to the code currency. Did you hear that? For example, if USD ZAR price is going up, this means the price is being bullish. If we get into the charts, when you see the market or the price going up, just know that we call that bullish. So what is bearish? Bearish is currently the opposite of bullish, meaning when the market is going down or the price is going down, then that is considered as bearish. So as we can see on this picture here, this is the price of USD ZAR. On this first uh, charts whereby the price is going down, that is considered as bearish because USD ZAR price was basically going down, and on the right hand the market is currently going up, and that means the market is absolutely bullish. So let's pass to another point. So what is spread? And all forex codes are quoted with true prices, being the bid and ask price, with which the bid is lower than the ask. The bid is the price that your broker is willing to buy a base currency in exchange to a code currency. This means the bid is the available price which a trader will sell to the market. If you take a decision of selling because the market is going down or is going bearish, that means you are what? You are selling the bid, and the broker is buying that bid from you. You get that? Meaning, for example, if you see that USD ZAR is going down and you want to sell, then you are selling that to the broker, meaning you are selling a bid price to a broker while the broker is buying that bid price from you. And also we have what we call ask price, which is basically the opposite of the bid. This ask price is the price that a broker wants to sell a base currency in exchange to a code currency. Meaning, when you are buying a what? A ask price, and then the broker is selling that to you. You get that? A bid price is basically the price that you are selling to the broker, while the ask price is basically the price that a broker sells to you. You get that? So in short, spread is the difference between bid and ask price. So if we can look carefully in this picture below here, we have a bid price on the left being what? Being the price you are selling to the broker, like I said, and the ask price being the price that you are buying from the broker. So the difference between those two prices is the spread, as I I showed it on the left by underlining it, meaning the difference between those prices is the spread. So let's get into another point. What is a pip? You will hear traders be saying, I sold the price and it went 100 pips, meaning the the trader gained from the market about certain dollars times 100 pips. So what is this pip? If USD rises from 16.0010 to 16.0012, that means 0.002 difference is 2 pips. You get that? In short, a pip is usually a last decimal place of the price code. Most pairs go out to 4 decimal place, while there are some which go to 2 decimal place. The value of a pip is determined by what? By a lot size. So guys, if you want to trade a certain currency pair, the last the last decimal place of that price is what we call a pip. Usually is on the 4th decimal place, and as for Japanese yen is usually on the 2nd decimal place. That's what we call a pip. So this pip is determined by what? By a lot size that you will choose to use. So what is this lot size? In forex trading, there are many lot sizes depending on one's decision. A lot size is determined or determines amount of money you'll make per pip. As you know that a pip is the difference between the two prices, being the first or initial price and the final price. So one pip will determine, or the amount of money you will get per one pip will be determined by what? By your lot size. So we have 4 types of lot sizes, being standard lot size. This is the biggest lot size in forex trading, but it's usually used for big accounts, not small accounts. As you can see that I indicated it with a red color because it's very dangerous for small accounts. It's very advisable to use that lot size only on big accounts. So standard lot size, this lot size usually starts from 1.00 volume and upwards. You can go for 2.003 and upwards depending on your account. So what you will benefit from one pip is literally $10 per pip. So if the price increases from 17 to 18, that means you will gain $10. So we also have mini lot size, which is basically from 0.10, and the trader will benefit $1 per one pip. And there's also a micro lot size, being 0.01. In this lot size, a trader will gain $0.10 per pip. And there's also a 0.001, being a nano lot size, which will basically benefit a trader with $0.001 per pip. So this is the advisable lot size for accounts, for the small accounts, which are basically less than $100. Yes. So in forex trading, there's also what we call a margin. You'll hear traders saying, I'm going to trade this pair with full margin. What do they mean with that? You'll basically understand after this course. So margin is the amount of money that the trader needs to put forward in order to open a trade. When trading forex on margin, you only need to pay a percentage of the full value of the position to open a trade, meaning this is the amount of money you are risking in order to open a trade. So you'll hear traders while breaking saying, I'm going to trade this pair with full margin, meaning they are risking all their money or their account in order to open a certain trade. So in Forex, there are also trading hours or trading sessions, the very perfect trading sessions. First, we have Sydney session, which begins at 9 o'clock p.m. to 5 o'clock a.m. in Greenwich time, and that is absolutely 11 o'clock in the afternoon to 7 o'clock in the morning in South African time. We also have a Tokyo session, which begins at 11 o'clock in the afternoon to 7 o'clock a.m. Greenwich time, which is absolutely 1 o'clock in the morning to 9 o'clock in the morning in South African time. So we also have a New York session, which basically starts from 12 o'clock in the afternoon to 8 o'clock in the afternoon in Greenwich time, which is absolutely 2 o'clock in the afternoon to 10 o'clock midnight in South African time. So there's what we call London and New York overlap. This is the busiest time of the day as traders from New York and London are trading. This is currently the very perfect time to trade, in short, because the market is the most volatile at that time when the both sessions are activated. It is during this time where big moves are seen on the market, especially when the news are reported from US and Canada. That's why from 12 o'clock to 3 o'clock Greenwich time, the market becomes so volatile as both sessions are active. Like we can see, guys, on this previous table that we have, London sessions begins from 7 o'clock in the morning to 3 o'clock in the afternoon, and from and then the New York session starts from 12 o'clock in the afternoon to what, to 8 o'clock in the afternoon, meaning from 12 o'clock, whereby the New York session starts, to 3 o'clock in the afternoon, whereby the London session ends. That's the most busiest, or the most favorable time for traders, as the market is very volatile because both sessions are active. So lastly, we have what we call a forex broker. What is a broker? This is a firm that provides traders with access to a platform so that they can buy or sell currencies. Meaning, brokers are, in short, your account managers, because without a broker you can never open any trading account nor buy or sell any currency. So brokers are that firm that gives you that platform of selling or buying the currency. So guys, if you were with me until this far, please click that like button, subscribe, share this video because it might reach when needed, and comment down below your questions and what you will need me to post or to make a video with on the next video.